talk about the state of the banking system right now. 140 bank failures in 2009.
Yes.
A few only so far this year, but we're just a few weeks into 2010.
Yes.
Will we see more this year?
Yes. Our projections are that it will peak this year, so it'll be higher this year than it was last year. You know, banks...
Why?
Well, a couple things. Banks typically lag economic recovery, that is, and that's throughout cycles. You'll typically see continued bank failures even after the economy starts to recover. There's still a lot of uncertainties about the economy. To what extent, you know, how robust is the recovery? What we're really seeing in terms of economic health. So we also have commercial real estate loans to still work through. The mortgages.
That's been a big concern of yours for a
long
time.
We've been talking about a long time.
Yes,
that's
ago.
right. Yes. Well, about a couple years ago, we were actually talking about this. It is a big concern. But we've known. The good news is we've known about it for a long time. We've been planning for it. It's embedded in all the stress scenarios. Well, a lot of it is just cooked. That's right. These losses are there, and we're encouraging banks to raise more capital. They have, and to set aside loan loss reserves to cover projected losses, and the vast majority will be able to absorb these losses and survive, but there will be a significant subset, a small minority of all banks, but nonetheless more than we had last year that will be failing. And a lot of this will be driven more by commercial real estate, whereas last year was more about mortgages.
The big banks, are they safe?
Well, I think the system's very stable right now. I think there's been a lot of capital raising. I think there's been heightened regulatory scrutiny, and we continue to push that. We are not the primary regulator of the very large institutions. We are the insurer. We're also backup supervisor, and we have strengthened our backup supervision of these large institutions in partnership with the primary regulators. I think as many sets of eyes looking at these very large institutions, the better it is. So we are stepping up our efforts there. And so, yes, I'm feeling good about the overall state of the banking system. I think things are stable. I think we do have the capacity and resources to work through this in a way that will not be disruptive going forward. But there's still a lot of question marks. You know, it's really so much about the economy right now, and that's something beyond my control. So we'll just have to, continue encouraging banks to do prudent lending, which will support the economy, and make sure our examiners are balanced in their approach, which we try very hard to do, and hope for the best going forward.
Does it look to you as though the bank failures this year that will surpass those of 2009 will be small regional banks and none of the big banks in this country at this point?
Well, you can look at our troubled bank list. There are 550, as of the end of the third quarter, there were 552 institutions on the troubled bank list, representing a total assets of $350 billion. So and most of those will not fail. I mean, that's the reason we put them on the troubled bank list, is to give them extra care and attention. But you can get a sense of in aggregate, the size of the institutions we're talking about.
Is it fair that the big banks are okay? The big banks that got TARP money are fine, and some of the little ones that didn't aren't?
No, it's not fair. It's not fair. I mean, some got 2 or 3 different opportunities to get government support, and certainly most of the programs were clearly geared towards the very large institutions. And we had to do that if there was systemic risk. If one of them was dissolved in a disorderly bankruptcy process. So that's just the reality. But no, it's absolutely not fair. If the smaller banks had gotten, a lot of the smaller banks, if they'd been given the same kind of generous support, they wouldn't have been closed. I mean, that's just reality.
Why do you think they weren't?
Well, it's part of the statutory structure that we have now, and I don't like bailouts, so I'm really not advocating bailouts for small banks. What I'm saying is that we should have a process that works for everybody, which is why I think going forward, we've done what we've had to do in the past, but going forward, we should have a resolution regime that allows large institutions to be put into receivership just as small institutions are. And you see higher capital levels in smaller institutions. In general, you see better credit quality in the loans that small institutions make. And the reason for that, I think, a large part of it is because they are small enough to fail. So those who invest money in them and extend credit to them are a little more scrutinizing because they know that their money is at risk. With the large institutions, I think there has been a perception now, affirmed that the government would step in and stabilize them if they got into trouble. So I think it's given them, they have more leverage, they can operate at lower capital levels, and they also get cheaper financing. Their financing costs which also can fuel growth.
Sure.
So I think having a resolution mechanism that says, big or small, this is what's going to happen to you, and your shareholders and creditors will have to take the losses. if you're mismanaged. I think that will provide a good dose of market discipline back into the larger institutions, and that in and of itself will help create pressure for them to downsize.
When we look at the risks of small bank failures tied to commercial real estate, are we looking at a lot of the areas where they have already been a number of failures because of the housing market plunge?
Right.
Las Vegas, California,
right.
parts of Florida.
Right.
Are we going to see them hit again in a sense because
Right.
they've got a lot of the commercial real estate issues there?
Well, certainly a lot of the commercial real estate was tied to the boom in the housing market. So, and particularly the hardest loans are the residential construction development loans, which really are we're seeing some pretty high loss rates on it. So yes, I would say there is some correlation between CRE, commercial real estate distress, and those areas of the country that have been more distressed in their housing markets as well.